$72.92. That is what silver costs right now if you want it on paper in New York. $75.12. That is what silver costs right now if you want it physically in hand in Shanghai. Same metal, same week, $2.20 apart and in a normally functioning market. That gap would close itself within hours as arbitrage traders hammered it shut before the morning trading session concluded. The fact that this gap is not closing, the fact that it is persisting and in some sessions widening rather than compressing, is the structural condition that this entire analysis exists to explain, because what is keeping that gap open is not a technical glitch, not a tax differential, not a data anomaly, but something operating at a deeper structural level that changes how every other signal in the silver market should be read. In the previous analysis, attention was directed to the COMEX registered silver inventory figure in the CME warehouse report, with a specific call that if another net withdrawal occurred while open interest held above 100,000 contracts, the divergence between paper price and physical reality would become harder for the market to sustain. Here is precisely what occurred. The drain continued, registered inventory tightened again, and open interest is sitting at 113,927 contracts, exactly where it was. The paper market did not respond to the physical signal. The physical market kept moving. 15 years in currency and commodity markets before transitioning to this work provides the vantage point from which that non-response is recognizable as analytically significant rather than routine, and everything presented here is sourced from named, publicly available data: the CME warehouse reports, the Shanghai metals market, the CFTC commitments of traders report, U.S. Treasury yield data, the DXY index, and World Gold Council reserve figures, with every source identified explicitly as the analysis proceeds. The spot silver front month COMEX futures contract is quoted at $72.92 as of this week. The DXY climbed to 104.50 on the back of a strong US jobs report, and when the dollar receives a strong bid, commodity prices quoted in dollars typically fall, which is exactly what happened in the paper market, exactly on schedule, in the manner consistent with the conventional macro reaction function. Walk across to the Shanghai metals market and physical silver is trading at $75.12. That $2.20 spread is not a footnote to the week's market action. It is the central story of what is structurally occurring in silver, and understanding why that gap is not correcting through normal arbitrage mechanics requires examining the physical delivery constraint that is the operational binding factor in the current environment. When a price difference of this magnitude opens between two markets for the same asset, professional arbitrage traders are theoretically positioned to close it through a straightforward mechanical sequence. Buy the cheaper version in New York, arrange delivery of physical metal into the more expensive market in Shanghai, pocket the spread, and in doing so push the cheap price up and the expensive price down until they converge. That is how the mechanism is designed to function. Here is where the constraint is operating in practice. The cheap product in New York is a futures contract, a paper instrument representing a claim on silver. To complete the arbitrage, the trader must actually take delivery of physical metal from the COMEX vault system, arrange shipment to Asia, and deliver into the Shanghai market. And that physical delivery step, the precise moment at which the trader reaches into COMEX registered inventory and extracts real ounces, is exactly where the tightening constraint is making itself felt. Registered inventory is the silver specifically earmarked for delivery against futures contracts, distinct from eligible inventory which sits alongside it in approved vaults but has not been formally committed to the delivery system and cannot be used to settle a futures contract with physical metal, and that registered figure has been draining week after week, not in a panic, not in a disorderly fashion, but consistently and in one direction, as arbitrage traders do precisely what arbitrage traders are supposed to do, reaching into the registered pool to close a $2.20 price gap through the delivery mechanism the market provides for exactly that purpose. The number that makes this structural rather than merely interesting is 113,927 open interest contracts on the COMEX, each representing 5,000 ounces, producing approximately 569 million ounces of silver represented in paper claims. Setting that against the registered inventory figure, the actual earmarked physical silver available for delivery produces what the market terms the coverage ratio, the ratio of paper claims to real deliverable ounces, and that ratio is currently at multi-year highs per the CME warehouse data. The coat check analogy makes this most tangible. Every customer who walked into a busy restaurant received a ticket with complete confidence from the coat check attendant, but somewhere in the course of the evening a significant number of coats quietly left through the back door, and the tickets still exist, the customers still believe their coats are present, but if everyone decided to claim their coat simultaneously, the arithmetic does not reconcile. The critical caveat that must accompany this analogy is that not everyone holding a COMEX futures contract intends to take physical delivery. The overwhelming majority will roll their position, close it for cash, or settle in dollars, which is how futures markets are designed to function and which is entirely normal and expected. The coat check description is not a prediction that everyone rushes the door at once. It is a description of what the structural conditions look like at this moment in time, and the ratio matters because it measures how much stress the system is under if delivery demand increases even modestly from its current baseline, and the arbitrage gap between New York and Shanghai is creating precisely that kind of incremental delivery pressure as professional traders do mathematically what the price differential incentivizes them to do. The drain is not sentiment. It is arithmetic. The honest treatment of the cautious scenario must be given genuine analytical weight before proceeding further with the structural thesis, because analysis that presents only one side of a genuinely two-sided situation is not serving the reader. The DXY at 104.50 is a real headwind. Not a dismissible one if the dollar index sustains a move toward 106, which is not an unreasonable scenario following a strong jobs report. Speculative longs in the COMEX futures market face genuine liquidation pressure, and when speculative longs liquidate, the paper price declines regardless of what is simultaneously occurring in the physical market. That is not theoretical, it is what occurred in every significant silver correction of the past decade, where dollar strength triggered futures selling, the paper price fell to levels that were uncomfortable for holders of leveraged positions, and physical buyers absorbed the dip before the price recovered, the bearish flush target. Identified at approximately $70 is a credible level if the dollar scenario develops as described. What the cautious scenario does not eliminate, however, is the Shanghai premium. In fact, a paper price that falls faster than the physical market can adjust creates a larger arbitrage window, which generates more delivery pressure, which drains registered inventory at an accelerated pace, the bearish paper scenario and the bullish physical structural thesis are not mutually exclusive in the near term. A painful paper price decline to $70 and an intensifying physical drain can occur simultaneously, and the distinction between those two conditions depends entirely on the instrument through which a participant is exposed to silver for a leveraged futures position. A move to $70 is a crisis. For unencumbered physical silver, it is a structural condition that is uncomfortable but entirely coherent with the data. The macro context connects the dollar strength story and the COMEX arbitrage story at a structural level that is not immediately apparent but is essential to the complete analytical picture. The DXY climbed to 104.50 because strong payroll data reduces the probability of near-term Federal Reserve rate cuts, and the 10-year Treasury yield sitting at 4.36% creates what traders identify as the opportunity cost argument against precious metals. Silver and gold pay no yield. A Treasury bond paying 4.36% does, and when yields rise, capital flows toward yield-bearing assets and away from metals at the margin. That conventional wisdom is not wrong as far as it goes, but the boundary of where it applies is precisely the boundary between the paper market and the physical market. The yield argument affects the hedge fund manager running a macro book in New York who is comparing risk-adjusted returns across asset classes and has the flexibility to substitute between instruments. It does not affect the industrial buyer in Shenzhen who needs physical silver to manufacture solar panels and cannot substitute a treasury bond for a process-critical raw material. It does not affect the Chinese retail investor paying $75.12 because that is what physical silver commands in their domestic market, regardless of what Federal Reserve rate signals imply about relative asset returns. The dollar and yield story is the paper market story. The Shanghai premium is the physical market story, and those two stories are running simultaneously on the same underlying asset with a $2.20 gap between them. The LBMA vault activity in London reflects the same east-west physical flow dynamic appearing in the COMEX data, and for UK investors holding silver in a SIP or as physical allocated metal, the macro headwinds from dollar strength and elevated gilt yields are real, but the structural floor thesis applies with equivalent force on the eastern side of the Atlantic. Central banks are not repositioning into treasuries in the current environment. The World Gold Council's most recent data shows continued net central bank gold purchases at historically elevated levels, and these are reserve managers making multi-year allocation decisions, not macro traders adjusting positions in response to a single jobs report, and when they purchase physical metal through the delivery mechanisms that connect to exactly the registered inventory pools that are currently draining. Industrial demand constitutes the structural foundation beneath all of these signals, and the Silver Institute's documentation of 5 consecutive years of structural supply deficits is the most significant long-cycle data point in the entire analytical picture. 5 consecutive years in which annual demand for silver spanning industrial investment and fabrication use has exceeded annual mine supply, with the gap filled by drawing down above-ground stockpiles that are not infinite in their capacity to absorb that differential. Silver is not like oil where consumption is visible and discrete. It disappears into solar panel contacts, into the connectors of artificial intelligence server infrastructure, into medical devices, into electric vehicle charging components, dispersed in microscopic quantities across enormous industrial systems and rarely recovered at economically viable rates from finished products because the Extraction economics from dispersed end-of-life consumer goods are frequently inferior to the economics of purchasing primary supply. 5 years of structural pressure in one direction does not function as a countdown timer, it functions as gravity, which does not specify the exact date something falls but does specify the direction and accumulating magnitude of the pressure, and 5 years of that pressure in one direction makes the system progressively more sensitive to exactly the kind of arbitrage-driven delivery demand that is currently operating on the registered inventory pool. The three lanes framework applied here organizes these signals into their proper analytical structure. The paper lane with COMEX front-month futures at $72.92, open interest at 113,927 contracts. The dollar at 104.50, the 10-year yield at 4.36%, and managed money using futures to hedge macro risk rather than to express a long-term physical view is pointing downward on sentiment, held there by dollar and yield pressure operating through the conventional macro transmission mechanism. The physical lane with the Shanghai metals market at $75.12, a $2.20 premium above the COMEX paper price. COMEX registered inventory draining as arbitrage traders pull physical metal through the delivery mechanism to close that premium, and 5 consecutive years of structural supply deficit documented by the Silver Institute is pointing upward on physical reality in direct and sustained contradiction to the paper lane signal, the macro lane is genuinely split in a manner that requires honest acknowledgement rather than resolution in either direction. Dollar strength and elevated treasury yields are near-term headwinds for the paper price that cannot be dismissed. While central bank gold buying at historically elevated levels and geopolitical risk in the Middle East creating weekend scenario uncertainty are structurally supportive forces operating at a slower frequency but pointing in the opposite direction. The specific metric to monitor this week is the COMEX registered silver inventory figure. In the next CME warehouse report specifically whether the rate of drain is accelerating, stabilizing, or reversing because that figure will communicate more about the direction this situation is heading than any price chart or macro headline. If registered inventory continues to drain at current pace while open interest holds above 100,000 contracts, the paper-to-physical coverage ratio tightens further toward a level where even a modest incremental increase in delivery demand creates outsized price pressure, and the COMEX has tools available to manage that. Condition margin increases, emergency rule changes, position limits whose deployment would itself constitute a significant market signal. If registered inventory stabilizes or eligible silver converts into registered status at sufficient pace to replenish the delivery pool, that would indicate supply is responding to the premium signal in a manner that reduces the near-term squeeze risk and gives the bearish $70 flush scenario more room to develop before physical buyers establish a durable floor. Both forward scenarios require equal treatment. In the constructive scenario, the arbitrage drain continues. Registered inventory falls to a level triggering genuine delivery stress on the COMEX. Short sellers face a choice between rolling positions at higher cost or accepting a loss, and a weekend geopolitical escalation adds a gap open premium on the Monday opening. Any combination of those conditions makes a path toward $80 coherent with the structural data. In the cautious scenario, the dollar sustains toward 106, the Federal Reserve signals no near-term rate adjustments, speculative longs liquidate under yield pressure pushing spot toward $70, and registered inventory holds because delivery demand softens or eligible metal converts at sufficient pace to replenish the pool. In that scenario, $70 is a real incredible near-term possibility before physical buyers establish a structural floor, and that floor, if it holds at that level, would itself be analytically consistent with the structural deficit thesis rather than contradicting it. All content presented here is for educational and informational purposes only, based exclusively on publicly available data, and nothing contained herein constitutes financial advice, investment advice, tax advice, or legal advice of any kind, nor should anything be construed as a recommendation to purchase, sell, or hold any financial instrument or asset class, and all investment decisions should be made in consultation with a qualified financial professional.